What's going on, guys? It's Vonzel, More Than Money, and welcome. All right, today, guys, we're going to be talking about price action. Price action. How to find and enter and place price action trades. Today, I'm going to show you guys some of the most intricate and precise entries on price action. We're going to go over some price action patterns and look how we can set our stop loss along with also our entry and an exit as well. So let's talk about our entry. Our entry is very important. It is very important because when you have an entry, that's going to let you know that you haven't been a sniper in the market. You want to be a sniper in the market. Your entry is very important. The way you enter the market matters because this lets you know if you're going to maximize those gains or minimize those losses. All right, maximize those gains and minimize those losses. You don't ever want to enter the market late. You always want to enter at the right time. And what is the right time? The right time is going to be based off the entry price action. All right. So buying and selling a currency pair in order for you to gain profit from the differences between the entry and exit price is your main objective in Forex trading. You want to enter the market and exit the market precisely like a sniper. This is how you're going to get your profit. Most traders think on their entries points and others believe that their exit is more important. So others think that entries are important, and then the others think that exits are important. But entirely, both of them are important. You have to be able to enter the market and have to be able to exit the market precisely to profit in the market. All right, to be a sniper in the market, you must know how to enter and exit the market no matter what. This is why candlesticks are going to help you. All right, candlesticks patterns are going to help you. You can use charts to determine everything that is happening in the Forex market. The candlesticks are going to tell you what the market's moving, if you're going to be in an uptrend or if you're going to be in a downtrend. All right. One of the most useful and common types of charts is the candlestick chart. You have your bar chart as well. All right. You have your line chart as well. But to see your price action, candlestick charts make a price action much identifiable. It makes it much identifiable due to the patterns, due to those patterns. So let's talk about the pin bar reversal. The pin bar reversal. Pin bars are one of the most powerful price action patterns in the Forex market. They are easy to recognize, which means both the professional and the retail traders use them. Retail traders like us and the professional like the big banks, they use them as well. The pin bar, also known as the Pinocchio bar, formation is a reversal setup. It is one candle, the bar formation that has an obvious large tail or a shadow either up or down. A pin bar is a single candlestick setup that clues price action into potential reversals in the market. We also know this as a hammer for the bearish or for the bullish and the shooting star for the bearish. All right, here we have our shooting star with our tail, and we have the hammers. All right, we have our bearish and the bullish, shooting stars and the hammers. All right, shooting stars and the hammers, bullish and bearish pin bars, bullish pin bars, bearish pin bars. So let's talk about our entries. The best way to trade any market is to trade in line with the trend. All right, remember, the trend is your friend. And a trending market, a pin bar entry signal can offer a better risk to reward, which means if you can see that pin bar or to see that reversal, that pin bar reversal, this is going to give you a better risk to reward. This is going to let you get into the market on a great entry. If the pin bar shows a rejection to low prices, it's a bullish pin bar. All right, it's a bullish pin bar since the rejection shows the bulls or the buyers are pushing price higher. So here we have our uptrend, and then this throws us a reversal pin bar. All right, throws us a reversal pin bar or our shooting star. Our entry is going to be the next candle. Our next candle is going to be the entry. Our stop loss is going to be above the wick, above the wick. Let's talk about our engulfing bars or the engulfing candles, also known as outside bars. These are the most accurate price action patterns. There are two types of engulfing bars. You have the bullish and you have the bearish. Bullish and bearish engulfing bar. Let's talk about the bullish engulfing. The bullish candle fully engulfs the previous candle. It can even engulf more than one candle. But to be a valid bullish engulfing bar, it must engulf at least one of the previous candles. It must engulf at least one of the previous candles, meaning the one right next to it. On the bearish engulfing, the bearish candle fully engulfs the previous candle. Both bullish and bearish candles have a lower low and a higher high. like the preceding candles. Look next to the candle on a bearish trend. If that bullish candle is engulfed, you're looking to get out of that. You're looking to get out of that trade. If you're in a bullish trend and that bearish candle engulfs, you're looking to get out of that bullish trade. All right. So how do we spot engulfing bars? Looking for the engulfing bars, they're pretty simple. All right, it's pretty simple. The candle should completely cover the previous candle's range, taking out the previous high or the previous low. Take out the previous high or the previous low. Here's your tip on the higher time frame. If you see an engulfing candle, all right, on the higher time frame, if you see an engulfing candle, look for the long-term reversal. Look for the long-term reversal, the daily, the 4 hour, the 1 hour. If you're in the 1 hour and you see that engulfing candle, look for the long-term reversal. If you're in the 4 hour and you see the engulfing candle, look for the long-term reversal. If you're on that daily, look for the long-term reversal. It's letting you know that the bullish or the bulls, the bears are getting into the market. All right, it's becoming a stronger trend. There is going to be a reversal in the market. So here's your example. We have a downtrend. All right, now we have a bullish engulfing. This is our bullish engulfing here. We see this bullish engulfing, we know this is our reversal. It's our reversal to the upside for a new trend. This is the real move. Now we have a reversal coming back for a new trend, a bullish trend. Here we had a bullish trend. All right, now we're going to have a bearish engulfing. We have the bearish engulfing here. This is our bearish engulfing. We have that bearish engulfing. Now we're going to have a new trend, a downtrend. We have a bullish engulfing. Now we're going to enter the market after this candle closes. We have a bearish engulfing. Now we're going to enter the market on this candle after this candle closes. Let's talk about our trend lines. Resistance zones. Trend lines are based off your resistance zones. Resistance zones could be great spots to target bearish reversal trades or to use with your exits. If you can recognize the zones of support or resistance on your charts, it will provide both valuable entry and exit points. Your trend lines are going to tell you when to get in the market and when to get out of the market. This is also based off your confluence. You can use trend lines off of confluence as well. There are 3 types of markets. You have the uptrend, higher highs and lows. You have the downtrend, lower highs and lows. And you have sideways. You have the ranging. So you got uptrend, downtrend, and ranging or consolidation. Your uptrend trend lines, your valleys. You're going to see these valleys and peaks if you go to a line chart. These are drawn along the bottom of the identifiable support areas. And in a downtrend, your lines, your peaks are drawn along the top of identifiable resistance areas. If you look at your peaks and valleys on a line chart, you switch from candlesticks to line charts, you will see that you can see the peaks and the valleys. These are going to hit on your trend lines. This will give you a better idea in the market is where the market is hitting your support and resistance area as well. Your inside bar. One of the most familiar candlestick patterns in the inside bar is the inside bar. It forms when price trades within the high and low ranges of a previous day. You can call an inside bar a breakout play. You're looking for that breakout play when you see an inside bar. The best inside bars are made in trending markets with the uptrend or the downtrend, or in layman terms, direction of the trend, uptrend or a downtrend. What you're going to get is you're going to get an uptrend, a little bit of consolidation, and then you get a breakout. Or you get a downtrend, a little bit of consolidation, and then a breakout. But you're looking for that inside bar. Now, the inside bar, what is it? The inside bar is formed when the second bar or a candlestick is engulfed within the previous bar or candlestick high and low. It is a 2-bar price action strategy, trading strategy, in which the inside bar is smaller and within high to low range of the prior bar. It can be at the top, middle, or bottom of the bar. So how are we going to spot this? You can see what it looks like in a line with a trending market. On this next slide, as you can see, it will be below. It's going to be in a downtrending market. So the inside bar pattern will be called the inside bar sell signal. The only way you're going to see this is if you draw a trend, or if you draw your support and resistance, and you're going to see the inside bar. Here's your example. You have your resistance and you have your support. Here is your inside bar pattern. Here's your inside bar pattern. Again, you have your support and resistance. Here's your inside bar pattern. Let's take a look. We have support up top, resistance up top and support in the bottom. Here is going to be your inside bar pattern. Here's another example. Now this time it's an inside bar pattern with a trending market. Again, the inside bar is best played with the breakout. In this example, the market was trending higher. So the inside bar we refer to as the inside bar buy signal. So you're looking for your buy. So as we see the market is going up, you see a little bit of consolidation. You draw your support and resistance areas, and you wait for that breakout for your inside bar pattern. So you have the market was trending up, came a little sideways. You draw a support resistance. All right. The market had a break and retest. It broke out. Now we have another inside bar pattern. What are we going to wait for again? Another breakout. All right. So this is your inside bar pattern, your inside bar pattern. So what about your entries? What are we looking for the entries on the inside bar pattern? Your support and resistance is going to be your main focus. Look for the support and resistance areas. In technical analysis, support and resistance levels are the most important concepts to determine long and short trading opportunities. Support is a price level where, due to concentration of demand, price will often turn around and be supported. Support is going to be your floor. All right, support is going to be your floor. When the market cannot push down, it's going to reverse and go up. If the market can't sell, the market is going to go the other way and go for a buy. Resistance zones are the opposite to support zones and are levels in the market where price is finding more sellers and less demand. In other words, price is finding resistance. In other words, price has a roof over it. It cannot break through that roof. Therefore, it's going to go the other way and go to the floor. Price cannot go for a buy. Price will reverse and go for a sell. Other price action patterns, you have a morning star, which is bullish, and you had an evening star, which is bearish. These two are some very powerful price action patterns as well. For our morning star candlestick pattern, we have a long leg, a small body, and we have another long leg. So again, two long legs and a small body. This is going to be your morning star. This is going to be for a bullish trend, a bullish reversal. When you see this pattern, this is going to be your bullish reversal. Let's talk about our bearish reversal, an evening star. We have a long leg, a short leg, and a long leg. This could also be a doji. Also on this could also be a doji. So this is going to be our bearish reversal. We have a long leg, short leg, or a doji, and another long leg. Our evening star is going to be our bearish reversal. Where are we placing our stop loss on these on these price action reversals? Note, set your own stop losses depending on your individual preferences. Set your stop losses based off your capital, based off your account, all right? Based on how much you want to risk. Know your risk before you enter the market as well. Never enter the market without a stop loss, and never enter the market without an exit, all right? Never enter without an exit or a stop loss. Always have those two in place. Let's talk about a pin bar stop, all right? A pin bar stop loss strategy. You can place a stop loss behind the tail of the pin bar, whether it's bearish or bullish. This is going to be your shooting star or your hammer. As a result, when price hits your stop loss, the pin bar setup will turn out to be invalid. This means that you set your setup, your analysis, but your analysis was untrue. The stop loss has been hit. Remember that the market is just notifying you that your pin bar setup was not strong enough. That means you did not pick the right trend, or that trend was not the correct trend during your market. Don't ever think that it's a bad thing when the market hits your stop loss. Do not get upset when the market hits your stop loss. Be excited that it did, because one, you don't lose anymore, but you know where the market's going to go. You know where it's going. If it hits your stop loss, that one means that you had a bad risk to reward, or your stop loss was just too tight. The third option is the market is just not done with that trend. The market's not done with that trend. So you need to relook at your reversal if you found the correct reversal. Maybe you did not see that pin bar. Maybe you saw an engulfing candle. Or maybe you got them mixed up. You could also put your stop loss spread times 2 above the wick of the higher low of the day, but also above the wick of the pin bar or the hammer. All right, above the pin bar or the hammer. So above the shooting star or below the hammer. That is where you can place your stop loss spread times 2. Again, guys, don't get upset if your stop loss is hit. Get back in the trade. Don't give up on the trade. Read that price action and get back into the trade. You can also use your confluence for a stop loss. With this strategy, you will use support and resistance levels, previous highs and lows, moving averages, trend lines, channels, anything that you need to do, indicators, anything you need to do with confluence to get to a market. Also for stop loss. All right. The good thing about confluence stops is that they're often used as obvious price levels in the market. Price has been there before, so therefore use that. Always look left in the market. Always find market structure. If price repeatedly takes you out of your stops by just a few points, add more confluence, add more confirmation to get out of that trade, or add more confirmation to get into that trade. Give yourself a little more padding in the stop hunt zone. Remember, the market is going to do what it wants to do, but also when you're looking for that stop loss, you need to also back test where price was. Always see where price previous was. All right, price is going to repeat itself. Again, history repeats itself. Price is going to repeat itself. So again, guys, recap: do not get into the market without an entry, an exit, or a stop loss. You need those three things. All right. A morning star and evening star are going to be your bullish and bearish reversals. You have your pen bar, you have outside and inside pen bars. You want to use these price action configurations, also confluence, trend lines, support resistant areas. You want to use all these methods on your price action when you're getting into the market and getting out of the market. Appreciate you guys listening, and I hope you guys learned something. Stay tuned for more.